So what have we seen recently? Well, out of COVID, the curve was bear steepening as the economy and markets recovered. Then from mid-21 until early 23, the curve has been bear flattening, with the short end rising rapidly relative to the long end in the fight against inflation. In fact, so much so that the curve turned negative, with financial conditions tightening so much to try to slow down the economy, but with little change to even lower long end rates. There are concerns here about the implications for medium-term growth. Hence, often the casual observation is made that an inverted yield curve reflects fears of a recession and referred to as a late cycle occurrence. Now, since March this year, the curve has been steepening somewhat, specifically bull steepening, with 2-year yields falling around 1.2% from their peak, but with 10-year yields falling less, by 60 basis points over the same period. In other words, rate markets believe the Fed will have to cut policy rates soon. So how does this all relate to equities? Well, a useful way to think about this is to consider how these yield curve shifts impact the S&P 500 historically, but split between what happened to earnings and what happened to the PE multiple. And this is what the table here tries to summarize. Let's go back to bear steepening. We're coming out of a recession, and the long end rises faster than the short end. This is historically associated with the largest PE expansion and the strongest returns, with earnings recovering also. Good data is treated as good news for the market. Then bear flattening. Policy rates now start to rise faster than the long end on fears of overheating. Invariably, PE multiples contract as financial conditions get tighter, but returns are still okay as there's earnings growth. In 2022, that wasn't the case, with the PE contraction particularly sharp, reflecting one of the sharpest Fed tightening cycles we've seen. Then into bull flattening, with long-end yields starting to fall but policy rates steady, but there's no imminent recession threat. Valuations historically have expanded, driving good equity returns. This is where there's a positive correlation between bond prices and equity prices, and long-duration stocks like tech tend to do well. And then into bull steepening. This is where there's typically fears of an economic downturn. And even though policy rates may be cut, PE multiples can't expand. Earnings growth is poor. Historically, this has been the worst phase for stocks.